Hello everyone. Firstly, thanks for the attention and for the click on this video. Myself Kavesha is Vinaysan, matrix number EX03681 from University of Malaysia, would like to present about a topic called the Enron accounting scandal, the story. I would like to thank my lecturer Dr. Muhammad Noor bin Osman for providing this golden opportunity as well. So allow me to proceed further with a short film about the story. Here we go.
Enron used to be the seventh largest corporation in the United States, at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We've then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
Thank you so much for the attention once again. So here I go about to explain the rise and fall of the Enron, the impact of it, what the auditors have done, last but not least, the lesson learned. So executive and board directors, Chairman Henry, CEO Jeffrey Skilling, Andrew Festo, and the accounting firm of Arthur Anderson. So let me just give a brief of their background. So Ken Lin, after a master's degree, he began his career in 1965 as a corporate economist with Exxon Company, and in 1984 joined an Houston natural gas company as chairman and CEO, merged with Internorth in 1985, and was later renamed Enron Corporates with Enron success in place. He drew down his $4 million Enron credit line repeatedly and then repaid the company with Enron shares. Jeffrey Steele started career after MBA and in 1987 started working as consultant for Enron. In 1991, Skilling was subsequently made CEO Managing Director for Enron's Capital and Trade Resources, equally responsible for the Enron scandal. Last but not least is our Anderson Fester. Joined at Enron in 1990, and Fester was accused of being the mind master behind the Enron scandal. So let me further talk about Enron's rise and fall. So throughout the late 90s, Enron was almost universally considered one of the country's most innovative companies, whereby with the old industry of the hard assets in the favor of freewheeling world e-commerce, the company continued to build power plants and operate gas lines, but it became better known for its unique trading businesses. Besides buying and selling gas and electricity futures, it created a whole new market for such oddball commodities, such as broadcast time for advertised, weather, futures, and internet bandwidth. Enron was founded in 1985 and as one of the world's leading electricity, natural gas, communication, pulp papers, and companies before it got bankrupted in the late 2001. As well as the annual revenue roses from about $9 billion in 1995 to over $100 billion in 2000. Also, in the late 2000s, it was revealed that its reported financial condition was sustained substantially by an institutionalized, systematic, and creatively planned accounting fraud, whereby according to Thomas 2002, drop of Enron stock price from $90 per share in the mid-2000s to less than $1 per share at the end of 2001. And Enron revised its financial statement for previous 5 years and found out that there was about 586 million in losses. Enron filed to bankruptcy in late 2001 December. One of the losses of the internet boom is that it's often difficult to analyze, to understand and evaluate the new kind of business. An executive like Mr. Silku, who once swore on the analysis during the conference for asking the pointer, he then do not much foster to be the kind of open inquiry that could lead to better information. As we can able to see further as well, that investment banks make far more money from underwriting or merge deals that they do not make for broker fees. Analysts at these firms often face conflict royalty, and they can put in the position of having to worry much of what other chief executives. In this case also has been emblematic of another problem that has become all too evident in the last 5 years, which is called the Wall Street of loss of city. So let me further talk about the causes of Enron's fall. A clear scene can be seen in 1993 to 2001. Enron also used complex and dubious accounting schemes, reduced Enron's tax payments, whereby to inflate Enron's income and profit. Nevertheless, also to inflate Enron's stock price and credit rating. These are also the reasons to hide losses in off-balance sheet subsidiaries. It's also a clear cut is to energize of off-balance schemes to funnel money to themselves, friends and family. A lack of independent oversight of management by Enron's board contributed to the firm's collapse. Why did the company also fail? Because it to fraudulently misrepresents Enron's financial condition in public's report, whereby millions of dollars was manipulated as long as the stock prices were high possible to keep the truth hidden. So as impact to it, what we can able to see that the lack of truthfulness by the management about the health of the company, according to Chris Henston, the executive director of the Nuclear for Applied Ethics. The senior executive believed that Enron had to be the best of everything it did, and they had to protect their reputation and their companies as the most successful executive in the US. The duty that is owed of one of the good and faith and disclosure. There is no evidence that was when Enron CEO told the employees that the stock would probably rise, that he also disclosed and he was selling stock. Moreover, the employees would have not learned from the stock sale within the days or weeks as is ordinarily the case. Only the investigation surrounding Enron's bankruptcy enabled shareholders to learn the CEO's stock sell off before February 2002, which was then sell off would otherwise have been disclosed. As we can also see that there has been a suggestion that conflicts of interest and lack of independent oversight management by Enron's board contributed to the firm's collapse, whereby some of the suggested that Enron's compensation policies engaged by focus of aiming growth and stock prices. In addition, the recent regulatory have changed their focus on changing the accounting for SPEs and strengthening the internal accounting and control system. Enron has also sought out salvage of its business by spinning off various assets. Explore the impact of auditor reputation on the client market prices around an auditor failure. So what can be analyzed in this is Enron acted in indifference against a system that they created. A lack of check and balances for decision making structures or accountability. Undefined ethical stance become a legal issue as well, which can be clearly seen in this. A components of leadership affecting a behavior and internal practice were very absent, as we can see that how the management has organized it. Limitation of leadership in practical sense were left unexplored. Moreover, underlying problems of compliance required a regular review process. Maybe last not least, Senior and middle management failed to create a climate that was conducive to include the organization goals and objectives. Let me look into the failure of an auditor and the board. As we mentioned, previously I've spoken about the analysis. So right now let me show why I have analyzed such. Because of the failure of auditor and board. Enron was fulsome in structuring the transactions and interest in making long-term complex transactions to achieve its desired objectivity. Enron had external auditor named Arthur Anderson. The accounting principal board APB made the certain changes to professional standards GAAP, and this element made the audit firm at high litigation risk, and also to develop standardized audit procedures to low cost and how many of the clients switched to low cost. It is an external auditor Anderson had to close relation with its client Enron, and it's an internal audit functions outsourced of Anderson as well. So it can be clear seen that Anderson had actually both the features which is internal and external audit, and also with their clients to switch to a low cost. 40 employees of an Enron shifted to Anderson's payroll. Very much a well-played game, but it became a failure. Anderson's employees shifted to Enron's as CFO, Chief Accounting Officer, and Treasury Officer. Anderson also served Enron for risk management, tax work, and affairs of assets. So it can be clearly seen that I've spoken about earlier that what I can analyze from it is all the factors that I've mentioned earlier. Moving forward, the failure of the Enron made by the auditor and also the board. Enron paid $25 million for audit fee, $27 million as an accounting fee, and also $15.7 million for other services. So there is a total of $67.7 million paid to Anderson. In 1990 and 2000, in client risk analysis, Enron was actually listed to high risk accounting. Anderson thereafter had to hide the documents where Enron showed its high risk. In February 2001, Anderson did an outline range of issues and discussed it that this might be he want to retain with the company. As the board finance committee reviewed the transactions quarterly and overlooked to create the SPEs. Board transferred power to the audit company to look internal and external auditor and financial reporting process. Compensation committee evaluates CEO performance and setting compensation. So here about the picture graph shows the rise and fall of the share price in June 2000 to November 2001 on the daily closes. As we can see, the Enron, the scandal, it actually reports about 680 million loss, its first quarterly loss, whereby in October 2001, Enron shares losses to fifth of their value, followed by November and December, whereby in December they have actually already filed a bankruptcy. What is the impact to the company? Basically, the company took highly unusual move to restart its profit for the past 4 years. It then admitted accounting errors, impacting income by $586 million since 1997. This is actually been caused Enron's failed for bankruptcy that in the biggest in US history. 20,000 employees lost their jobs and medical insurance. In 2001, employee losses about $1.2 billion in their retirement funds as well. Average severance of pay of $4,500, whereby top executives were paid bonuses totaling to $55 million and cashed in $116 million in stock. So we apparently can see that due to some systematic fraudulent of Enron's scandal story had incurred, the company in the end actually went through a bankruptcy, a loss of employees, jobs, and also thereafter payments of guilty feelings where some of them had to go with a justice in sorry. Last but not least, I would like to talk about the conclusion and the lesson. So let me firstly make a conclusion in this. Enron became a large failure partially due to its length, complexity control to defy the integrity of capital market field. A huge greed of coalitions of key members, whereby management, auditors, analysts, either creditors nor bankers failed and additionally regulators failed as well. So most of the board of directors in this company fail to play their role as what is required in an organization company. And the multiple of failures sent into a single control shape. So as a future accountant, a lesson learned and a suggestions can be given. So let me see what the lesson learned is. To require a proper focus on core values that guide the most useful principles. Importance to enable safeguards to protect ethical climate. To have a good comprehensive understanding of assets, tools and resources can prepare leadership. Also, a very important thing is to have a management finds a new solution for a new problem that which can be encountered. So it's a very important thing that every management or manager should find a new solution whenever there's a new problem has been encountered rather than in manipulating and hiding the big risk. Implement systems that measure the effectiveness of ethics initiatives. Refuse to tolerate misconduct from the top to bottom of the management. So here are the few steps or ideas that I can able to proceed is which called the 8 easy ways to follow. Firstly, we can see from vision. Where do you want your company or your industry to be in the next 5 to 10 years? Secondly, current assessment where you can see where you want now, strengthen, weakness, opportunities or threats. Choices of on our hand. Scope. What activity should you do? What are the resources required or needed to make a company go with a flow? Environmental policy. Make a community. Make a good better understanding within the employees, board of directors and managers. Action plan. Make it happen as well. Furtherly, implement the action and monitor and correct it, which is very important in every organization company. The second loss will be clarify or interview. So if there's any information or there's any such pieces, ensure that you clarify and interview them to see what are the suggestions or better understanding can be made. Last but not least, report. What to tell, how and when. So as these 8 steps can be conducted by a company, I'm pretty sure that they can able to well organize and bring a good growth to the company and to avoid any bankruptcy or any hidden issues. So hereby I have actually briefly explained the Enron accounting scandal, which is the story. Thank you. The end.